Good morning. It's Wednesday, the 29th of May, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Our top stories and themes of the day. Investors are increasing long positions ahead of election results. Now 4 trading days left for June 4th. Foreign investors are looking at Indian debt differently from equity right now and amping up investments. Indian drug makers have a strong year ahead with increases in imports from countries like the United States. How Toyota is sticking to a hybrid bet against many other manufacturers who are going full out on electric. And weight loss drug sales go from $24 billion last year to $138 billion projected in 2028, or just 4 years' time.
This is a core report with Govindraj Ethiraj.
Markets are subdued even as investors increase long positions. 4 trading sessions to go and the nervousness is picking up. Remember, exit polls for the general elections 2024 will start coming out on June 1st. That's the day after the last trading day of this week. So how the markets will go on Monday, June 3rd, the day before counting on June 4th, is anybody's guess. But remember, as we've been saying or documenting, the market's already priced in a BJP victory, which is why most institutional investors are now mentally and otherwise gearing up for an upset of any sort. Not because they believe it will happen specifically, at least going by the conversations I'm having, but it is their job to prevent or rather prepare for all eventualities. More on that in our new section view from London shortly. Retail investors also seem to be piling on to the derivatives market ahead of the results next week, and more on that too in a moment. So on Tuesday, the stock markets were fairly unsure and perhaps nervous, and that could be the tenor for the next couple of days as well. Quite likely, because I would think it's tough to talk up this market anymore, as several politicians have already attempted, and on the other hand, another bounce back or two is quite feasible. This is because stocks have now dropped for the third straight day on Tuesday, that is, after hitting record highs all the way. The BSE Sensex, which swung again in Tuesday trading between gains and losses, closed near the day's low level of 75,170. That's down 220 points, while the Nifty 50 closed at 22,888, down 44 points. Retail investors seem to be making a bold bet on the derivatives market a few days ahead of the 2024 election results. The Business Standard reported, quoting National Stock Exchange data, saying they were holding about 53% long positions in index futures as of May 27th. On the other hand, their net stock long position in the futures and options segment stands at about 90%, which is the highest level 5 days ahead of the vote counting day since 2014, when the Narendra Modi-led National Democratic Alliance, or NDA, assumed power. On the other hand, volatility levels are high. Business Standard again reports the India VIX has spiked to levels of 26 as compared to 10.3 in April 2024. That's obviously last month. It's still much lower than the 35 odd levels seen in 2019. Now, all of these statistics are, of course, to make you more interested, keen, or just nervous. Elsewhere, crude was quoting a little over $83 a barrel, even as Reuters reported that Reliance had struck a deal with Rosneft, the Russian oil major, for crude, but it would pay in rubles. Reliance, one of the world's largest standalone refiners, has signed a 1-year deal with Russia's Rosneft to buy at least 3 million barrels of oil a month in rubles, said Reuters. And the shift to ruble payments, which of course is unusual, follows Russian President Vladimir Putin's push for Moscow and its trading partners to find alternatives to Western financial systems to facilitate trade despite US and European sanctions, according to Reuters. A term deal with Rosneft will also help companies like Reliance get oil at discounted rates at a time when the OPEC Plus group of oil producers, that's the Organization of Petroleum Exporting Countries, is expected to extend voluntary supply cuts beyond June. From oil to gold, prices are now softer after investors are now obviously selling as they are in other commodities as well. That's because gold, as you know, has also been hitting all-time highs, though it's now at about $2,343.99 per ounce, below its 21-day moving average, which is about $2,348 per ounce, according to Reuters. The London view on markets.
Ladies and gentlemen, this is a securities announcement.
So, how are Indian markets looking at this point from a slightly longer distance? Before I go further, Reuters, incidentally, is reporting that foreign investors are increasingly being drawn to the traditionally overlooked rupee-denominated corporate debt market in India as they gear up for the inclusion of domestic government securities to a global bond index next month. That's the JP Morgan Bond Index. Now, while current investments remain modest, four bankers and fund managers told Reuters they anticipate an uptick as more investors familiarize themselves with Indian debt instruments. So the point here is that when you think of how foreign portfolio investors are investing in India, think both debt and equity, since the country view is what matters, at least in a longer-term context. So the US markets were closed on Monday and were steady overnight. The US stock market is also finally as fast as it was 100 years ago. And that was the last time share trades in New York settled in a single day, as they will from Tuesday under a new Securities and Exchange Commission rule. The change called T+1, that might sound familiar to you, halves the time it takes to complete every transaction. Coming back to what the foreign portfolio investor view on India right now is, I reached out to London-based Arvind Chari, Chief Investment Officer of Quantum India or Q India, and I began by asking him how he was reading the mood for both debt and equity.
If you look at flows, if you look at markets, the flows has been more positive. The story has been more positive in the bond markets as compared to equity. As you said, 5 days into the election results, we're also 3 days into the bond index inclusion, right? It's supposed to happen from June, and every month there will be a 1% increase in India's weight into the EM bond index. So that's finally happening. So we've seen proprietary trading or hedge funds or active funds already taking in positions. So we saw reasonably large inflows in last year, in 2023 calendar year. I think what's $8 or $9 billion. And YTD, I think we have seen about $7 billion of foreign flows into the Indian bond markets. And if I look at the recent increase, we have seen more investments in longer tenor, duration, as we call it, longer maturity paper as compared to the 3-year, 5-year space, which also tells you that the foreigners are not only betting on the inclusion happening and flows coming in, but they're also positive about the interest rate cycle. And we have seen long-term bond yields go down. So I think that is a far more attractive story from a flow perspective, especially from a flow perspective. And I think you will see a more secular flow. It, of course, depends on the election results, right? Because if you look at in the last 10 years, this Modi government has, if anything, they've done two things very good: is inflation control and a commitment on fiscal stability, right? Whereas if the India alliance wins, people will have the memories of Fragile Five and the fiscal and inflation impulse which is into that. So till the time they come and clear out what is their economic policy, markets will be edgy. So that's going to be a big point for the bond markets in terms of which government comes into power. If the BJP government, which is supposedly looks like it's going to win, you will see some more easing in bond yields, and you will see a lot more structural secular bond flows as well. But if it goes other way, then the markets will take a bit of time to figure out the budget and the economic policy and what comes out, and then make up its mind. From a macro perspective, I think India is inflation is very much under control. The rupee is relatively stable, and the potential for RBI to cut rates over the next 3 to 6 months is always there in the market. So those factors are positive, but the election can actually be a very significant point in terms of, in the medium term where bond yields go.
Yeah, that was my question really. So how are you seeing the equity flows, which are of course right now down as compared to until March and into April where they were going up?
It was going up both from global flows and global ETFs and global active and India dedicated flows. You were seeing India dedicated flows into Indian ETFs and into Indian actively managed funds. I think that has slowed down. You're seeing that in the numbers as well. The cash equity numbers are actually down. So that seems to have slowed down. Maybe getting into elections as one point in terms of uncertainty of the result. But more importantly, it's also about valuation. India looks expensive. We are value managers, and we've managed the Quantum India value equity strategy since many years, and we have a sense of what is our upside potential of the portfolio given the valuations, given the portfolio, and it is way below our long-term historical average. So that itself tells us, our own client guidance is that if you want to invest $1, invest half or a fourth or a third in India, purely given at valuations. And not valuations, potential returns that you will get over the next 2, 3, 4 years. This is in a liquid large cap strategy. the valuation problem is even higher in mid cap and small cap. And maybe we are seeing some of that being taken out. You're seeing some outflows from, I could see some outflows from India dedicated mid cap, small cap ETFs and funds as compared to large cap. So that's where the story is. One is just the election uncertainty. Second is valuation. And third, I think, is the global allocation. There was again a trend towards investing in China. And you saw that it's very short term in nature. You saw that in Feb, March, and April, where again you saw allocations going back to Chinese equities predominantly from their attractive valuation perspective. And we have to see whether that money was basically taken away from India and gone into China. But we would know for sure. But that's where the sense is. I think in the last 1 week, I just read a Twitter post saying that the FIs have cut down their index short. So they had a very significantly short position on Nifty futures, and actually they've cut it down. So which means that I think the market is entering neutral. Domestics are majorly invested, and I think foreigners are kind of neutral in terms of flows, near-term flows. But that makes sense going into 2-3 days into the election result, because we've seen, although elections do not have any impact on long-term returns, but we know that in 1 week, 2 weeks, the market can actually correct or spike up. So,
right. Between, let's say now, what you just explained on the way investors are looking at bonds, and that's clearly still rising, versus equities, what does that tell you about the way investors see the India story and how bond and equity investors see it differently, perhaps?
In the bond story, the underallocation is very, very significant, right? Foreigners own less than 2% of Indian bond market. And in their portfolio as well, in their overall bond portfolio, India would be, not even a basis point of the allocation. So in bonds, it will be for them to, take more positions as macro stability gets better and as they get confident and as the index allocation size increases, right? So that's a larger issue. As I said last time when we spoke, that the bond index story for Indian bonds is the same as the equity story when India got included in the MSCI India Emerging Market Equity Index back in the late 90s, early 2000s, and you saw an increase in foreign allocation. So that's the structure. Like, it's more structural. We might still see what we call bond tourists, where people are coming in and going out. And that's very likely in bond markets because it's a very arbitrage-driven flow, and there's an opportunity cost of capital that people think about what yields are globally and what yields are in India. So right now, that is not very attractive given US 10 years are still at about 4.5%, 5%, right? Closer to that. But it's a story where more allocations will happen to India. In equities, although globally investors are still underallocated to Indian equities in total, but people do have reasonably large allocation in their portfolios. Like if you look at any emerging market fund, about 15 to 20% of the allocation will be in India. Now, the total size of emerging market assets is much lower as compared to what global investors have in developed market equities. So that will change as India grows and India becomes larger and larger part of the global economy. But the sizing difference in terms of allocation is very starkly underweighted in bonds and reasonably there in equities. So in equities, there will be, of course, structural flows. As I keep saying, many investors do not have dedicated allocations to India at all. They have for China, but they don't have for India. And they will start making those allocations. But in an emerging market allocation, a lot of people invest in India through emerging market, right? Either through funds or directly. There it is a subject of, what is India's weight and what is the attractive valuations globally. So it's more relative. So if the market cracks, you will see many more flows coming in straight very quickly because, the attractiveness of Indian valuations gets better because the structural story is still there. And the Indian macro cycle also is very conducive, right? You're seeing private investments finally coming back. You're seeing inflation and deficits under control. You're seeing corporate margins expanding and the activity getting a bit more broad-based. If I look at other sentiment indicators of incomes and consumer sentiment, everything is going up, especially in the last 5-6 months. And that should continue for a period of time. So that's a structural part. But of course, from a flow part, it's relative valuations right now in Indian equities, which is not as attractive as it was, say, in Jan, Feb, March, for example.
Right. Thank you so much for joining me.
Thank you so much for having me.
Why this year is looking good for India's drug manufacturers. Indian drug makers, which have the US market as a key segment, will sustain their revenue improvement in fiscal 25 due to drug shortages in the United States, Mumbai-based India Ratings and Research said on Monday in a report quoted by Reuters. So, Roughly 50% of India's $55 billion drug industry is geared for exports. India is also a hub for bulk generic drug manufacturing, and major drug makers like Dr. Reddy's, Sun Pharmaceuticals, and Cipla draw a significant share of revenue from both US and Europe. But the US, the world's largest drug maker, is facing decade-high drug shortages, India Ratings said, citing data from the Utah Drug Information Service. There is an active shortage of 233 drugs across 22 therapeutic categories as of April, led mainly by discontinuing production of some drugs, rising demand, and delays in shipments, it said, also citing data from the US Food and Drug Administration, all quoted by Reuters. Now, large Indian manufacturers are already reporting spikes in sales, but what's the outlook for the industry as a whole? So I reached out to Dr. Viranchi Shah, National President of the Indian Drug Manufacturer Association and also Managing Director of the Ahmedabad-based Saga Life Sciences. IDMA was set up in 1961 and claims over 1,000 active members. I began by asking Dr. Shah to give us a quick overview of India's drug manufacturing industry at this point, and also a sense on how exports were looking for the industry at this point, as well as, of course, the domestic market.
Indian pharma has always been a very bright spot, if you would like to put it that way, in the Indian entire economic sector. This industry has always been, for the last 3 decades or so, revenue positive in terms of earning the foreign exchange. We are currently cited as number 3 in the world in terms of number of units of drugs that we produce all across the world. Every single country on this planet imports one or more drugs from India. That's the kind of global position that we hold on today. And going forward, the industry has a very strong plan, both on the micro and macro levels, for the next 10 to 25 years. We, as an industry, we have been identified as one of the strong industries to grow for during the Amrit Kal, which is for the next 25 years. And the trend is very positive. We have always grown. If you see the growth for the last 10, 20 years or so, we have always grown in excess of the GDP growth of the country, which means that it is one of the most promising and progressive industry. You must be aware the current market size of the Indian pharma industry is close to 55 billion this year, almost equally split between the domestic market and the international market. Internationally, of course, US is our largest customer, followed by Europe and followed by emerging markets. So especially post-COVID, we have seen that there has been a lot of interest from a number of stakeholders, including global governments, in investing and strengthening their supply chain as far as the healthcare deliverables are concerned, and pharmaceuticals remain a very important element of that. And during COVID, we have been able to supply all essential drugs as well as vaccines to the world. So we have proved as a very reliable source for global markets. So that way is a very strong industry poised to take another leap in the coming 10, 20 years or so.
Right. Okay, so tell us about how this year is looking, and in the context of, you did mention that US is the largest exporting destination, and are we seeing big pickup? I mean, of course, the numbers are already showing a pickup, but how do you see export opportunity or potential for the rest of the year?
Right. So as far as US is concerned, you must be aware that India has the largest number of US FDA approved sites outside the US. We have a permanent office of US FDA in India, which actually plays a very positive role in achieving a very strong market presence in US. US is one of the fastest growing markets for the Indian pharma. Currently, last year, I think it has grown about 10%, while the total exports, which has increased from approximately 25.3 billion to 27.8 billion USD last year, which was about 9.6%, around 9.5, 9.6%. But US has grown in excess of 10%. So it has been one of the most, and that too, it is the largest contributor in terms of the overall exports for India. So it is a very important market for us. And we have been able to do, as a nation, we have done great success in the US market.
Are there sort of specific kinds of drugs which are bigger? I mean, for someone who doesn't have a very specific understanding of this industry, or is there like more specialization? Are there some companies which are, let's say, doing more or doing better because they're focused on those specific generics and so on?
In terms of manufacturing, we have close to about approximately 5,000 units, right? Out of it, the significant player could be, let's say, first 300 to first 500, the first top 10%. My sense is that almost all of these 500s are into international market. So they are playing both in the domestic market as well as on the international. Of course, they have individual strengths. So there are companies who are focused on, for example, certain therapeutic segments, like let's say oncology, or there are companies who are they have a strength in APIs. There are companies who are more into chronic segments, in acute segments. So of course, every company has a strength. But overall, it seems that in India's strength currently lies in the small molecules. So we are not that strong in biologics. For example, if you compare it on a larger map, so we are strong in chemistry-based small molecules. That's where we dominate. Even in terms of dosage forms, we very strongly dominate the OSD categories, which is the oral medicines. Though we have a significant presence also in the parenteral and injection kind of products. So I think we as a nation, we cover almost the entire spectrum.
Right. So if I were to use the US again as an example, since I am picking up on that report, I mean, so the report says that there's one is, of course, the active shortage of drugs, and also because some drugs have been discontinued in the US, and also at the same time, there has been rising demand. How are Indian players geared for this increased demand, both right now as well as do you see more capacity investment happening here, or are we still operating below, let's say, peak capacity?
If you're specifically talking of US, Indian companies are actually in a very sweet spot. And the reason I'm saying what I'm saying is because if you see the inherent strength that we have in India, for example, for new companies, the taxation is very low. You can go as low as 15% in terms of taxation. The inflation in India is moderate if you compare it that with many of the other economies. The industry has both skill and knowledge. We have over the last decades or couple of decades developed the capabilities which enable us to cater in terms of our quality compliance, our GMP compliance. We have large number of plants that are approved by US, Europe, and a lot of stringent regulatory authorities. So this entire ecosystem has given us an inherent strength to cater to the world. At the same time, if you compare it with US, now you would have seen that almost more than 50% of the ANDAs approved in the US for the last several years have come from Indian companies. And I think this is more fueled by another factor which is very recent, which is the inflation. The inflation within the US is high, and therefore the cost of transacting these kind of activities in US, for them, generics is a low end of their pyramid, if you put it that way. So with the increased cost of inflation, increased cost of doing things, I believe probably a US company would be more interested to utilize their funds and resources in, let's say, maybe some high valuated products. So the generics become a sector which is, because of the strengths that we have and the problems that are there inherent of doing the same thing in US is so expensive that it makes this sector very, very lucrative for India. And Indians, the kind of strength that we bring, I don't think companies from any other country can bring. That's basically the strength.
So as you look at 24, 25, are you seeing, therefore, let's say, more or higher growth compared, because is there a spike in growth levels this year likely in the international market, which I think you already said is the case? And then maybe you could add a little bit about what's your outlook as IDMA president for the Indian market for this year.
So for the international market, of course, we have grown almost 10%, 9.4, let's say 9.5% last year. And I believe that our growth is going to exceed, it is going to be in double figures this year, which is the figures of April were in excess of 12% as compared to April last year. So we are expecting a growth at least in double figures this year for the international market. In Indian market, the growth was approximately around 6.5%, 7%. I think it continues to grow at that or a little higher pace than, let's say, around 7.5% for the domestic market. There are very promising trends to suggest that the kind of control that we have, like, I think the most important factor is the inflation, because that is one thing that is playing around in almost all economies. Now, if you compare it, the Indian inflation versus the growth in the GDP, and you compare the inflation in US or Europe as compared to their growth in their own economies, I think we are much better placed to take a very large, advantage of what we can do.
Right. Dr. Shah, thank you so much for joining me.
Thank you so much. It's a pleasure.
Toyota continues its bet on hybrids. Toyota Motor has showcased next-generation engines on Tuesday that could be used in cars as varied as hybrids and those running on biofuel as it targets tougher emission standards and doubles down on its strategy of selling more than just EVs, Reuters reported. Toyota is the world's largest auto company by volume, and it showed in development 1.5-litre and 2-litre engines with significantly reduced volume and height versus current engines. Toyota said, along with Subaru and Mazda, in which it owns stakes, that with these engines, each of the three companies will aim to optimize integration with motors, batteries, and other electric drive units. And the three companies also said that their efforts will help decarbonize internal combustion engines by making them compatible with alternative fuel sources such as e-fuels and biofuels. The larger point, as is evident in India, hybrid is selling faster than electric right now, and companies like both Toyota and Suzuki in India, that's Maruti Suzuki, are ramping up their hybrid productions. Toyota, by the way, has stuck to its guns on this one, saying that fuel-burning engines have a role to play even as the industry shifts to battery electric vehicles in a global push to decarbonize. Bloomberg reported that the Japanese manufacturers have long been criticized for hesitating to fully embrace electrification, while BYD of China and Elon Musk's Tesla take the lead in battery-based EVs. Toyota's chief technology officer did not give a time frame for when Toyota's new engines would show up in its vehicles, but said they will make sure to have them in the market before stricter emission rules were enforced. Toyota has long argued, and this is the more interesting strategic part, not just for an automaker, but for anyone betting on technologies, that multiple options would be needed to navigate the shift to electrification, an approach it calls a multi-pathway strategy that offers customers a broad choice of powertrains, including hybrids, hydrogen fuel cells, and combustion engines, apart from battery EVs, according to Bloomberg. Many car manufacturers, incidentally, including the German majors, have echoed similar approaches. Weight loss drugs are now going into blockbuster sales territory. As millions seek access to weight loss drugs from Novo Nordisk and Eli Lilly, increasing supplies, possible wider usage, and a growing number of would-be rivals are leading some experts to raise their global sales forecasts for the treatments to about $150 billion by the early 2030s. A year ago, to put things in context, top sales estimates were in the $100 billion range. Now, there are no Indian numbers in this specifically, but obviously it's a part of it that I have at least. But the market here is growing very fast, if not faster, and is already worth over 400 crores annually. It's very unusual to have a medicine that's capturing the imagination of millions of people, a senior research director at healthcare analytics firm IQVIA Institute for Data Science said. So, global spending on obesity medications totaled $24 billion last year. I repeat, $24 billion. And could reach $131 billion by 2028. That's 4 years from now. So that translates to a 27% annual growth compared to the prior projection of 13%. Analysts Reuters quoted also cited recent data showing that self-injected drugs help stave off costly emergencies like heart attack and stroke or treat chronic conditions like sleep apnea, supporting the case for employers and insurers to pay for them. This, of course, is more in the United States and other European contexts. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.